Hi there, ladies and gentlemen. Welcome to another live webinar with us from Phillip Nova. This is Sri, your facilitator of the day. Let's just give a few more minutes for our friends to join us. If you're having a dinner, great. Enjoy your dinner, sit back, relax, and I hope you learn loads from our speaker, David, today. All right. So we're going to kick things off very, very shortly at about 7:02 p.m. Let's just give some time for our friends to join us. I hope you're curious about the European market as I am, and hopefully we gain some valuable insights from Mr. David Ng himself. Okay, and stay tuned right to the end. We'll share details of our promotion that Philip Nova has for the European markets. All right, 7:02 p.m. This is your facilitator of the day. My name is Sri, and welcome to another Philip Nova webinar. In the studio, we have David Ng. But before I tell you more about the speaker, let's dive into the topic at hand. From autos to energy, what is trading the new Europe? Europe's markets are undergoing a major structural shift. Sectors like autos and energy are once again at the forefront, with European stocks recently hitting record highs on tech and chip rallies, and the EU is pushing aggressively toward clean energy, just like almost every other nation is pushing for green energy. And we have autonomy in battery production, and traders have fresh opportunities to ride the new wave. In this webinar, we will decode how tariffs, politics, and policy shifts under a Trump era backdrop may shape the European markets. You hear the speakers take on Europeans' economic pulse and how index rebalancing is tilting weight towards autos, energy, and green transition plays. This session will also provide actionable trend trading strategies for the Eurex markets so you can position yourself smartly in this evolving landscape. Okay, whether you trade indices, sector plays, or commodities, this is your chance to understand how Europe is realigning and where the real value may be found. All right. So some key topics that we'll touch on today, we will be touching on the tariffs and politics under Trump and the impact to the European markets, Europe's economic landscape and forward trends, index rebalancing, and how autos and energy are gaining weight. All right. And lastly, David will also touch on trend trading strategies for the Eurex markets. Just a short note, Philip Nova has a trading promotion for the Eurex DEX and the Micro Stocks 50 micro DAX and micro Euro Stocks 50. You can gain access to these contracts with a commission rate of just 150 euro. All right. So I'll tell you more about that later. I'll share the link in the chat box later so you can click on it towards the end of the webinar. Let me tell you about our speaker. He's none other than David Ng. If you've been attending our webinars, he'll be a very familiar face to all of you. And he's a proprietary trader with Iceberg X in November, a local prop trading firm based in KL. He's done extensive research and is well versed in the commodities and indices markets. He currently trades the Malaysia Index and crude palm oil. So if you have questions on the Eurex market, since that's what we are focusing on today, do type them the questions at any point in time during the webinar in the question box. Okay, so if you move to your control panel, or if you're on mobile, it could be somewhere at the bottom. Click on the box with a question mark on it. You can type your questions in there. Before I hand the time over to David, can you please let me know if you can hear me loud and clear? Just to ensure that everything is set up fine on the auto front. All right, let me know if you can hear me loud and clear. Type a yes in the question box. All right, David, if you're all set to go, I can hand the time over to you and you can walk us through the new Europe.
Okay, thanks, Sri. Just a quick sound check. Can you hear me, Sri?
Yeah, loud and clear.
Okay, that's great. Yeah, just firstly, just like to thank the audience for making it for the session tonight, and obviously thank Philip Noah as well as Eurex for inviting me to speak on today's topic. Now, I think Europe is transitioning from the good olden days. If Europe people talk about Europe, they are known for their best vehicles like brands, Mercedes-Benz, Porsche, and whatnot. So I think the economy is slowly transitioning away from autos and to the new energy. Which I'm going to share with you why is the reason, and I think that's going to be a new theme that's also slowly emerging. So if you are trading the DAX or even the Euro Stocks 50, I think it's something that for us to take note of. Now, eventually, I think if you just look at performance of Euro Stocks or even DAX, both these markets are reaching all-time high levels, synonymous with, and quite parallel with how the US market has been behaving for the past couple of months. So let's just start. As usual, a risk disclaimer. So the materials presented here today is purely for educational purpose. So opinions that is reflected by me is purely my own. It doesn't reflect any opinion whether it's from Philip Noah or even from the exchange. Now, if you are new to futures market, do take note that futures involve risk. It's a derivative instrument, leverage instrument. So make sure you're well equipped and get a sufficient knowledge before you actually embark on your trading futures. Now, I'm just going to share a few, four key points which we're going to talk about. I think if you look at where the economy of Europe is quite intertwined together with the US economy. And Trump being Trump is highly volatile, highly uncertain. So whatever policies that he mentioned, he can change it at the blink of an eye. So, if you are trading a market, really we will also have to watch what Trump is going to do in regards to tariffs. So tariff and politics, especially the U.S. Trump politics, is going to be quite a major impact when it comes to the European market. Now, Europe's economy, if you look at the balances of some of the European region, there's mix of performance. Now, even Germany itself, despite DAX hitting all-time high, you can see unemployment numbers are coming out. There's also a political uncertainty, you know, and there's also other key economic barometers that does indicate to you that Germany, despite being the largest European economy, might face a bit of headwind going forward. But in reality, despite economy showing you headwinds down the road, but you look at where the equity market is. Equity market are still pretty much on optimistic level. But if you look at technically speaking, which is I'm going to share in the second part of this session, technically speaking, I think DAX is probably heading for a sideways market, and if there's no further breakthrough of the previous high, probably there'll be a temporary peak as what we're seeing right now. So autos, we are transitioning slowly. If you look at DAX and Euro Stock 50, both these indices has actually done their rebalancing in the, I think it's late last month. So that's taking out some of the key auto players and putting some of the key energy players. So you can see that slowly the sentiments have shifted away from automobile makers and moving into the prospect of energy providers. So keep in mind, people now are talking about AI boom, and AI boom, the proliferation of data centers, that will definitely be very energy intensive. So being such an energy intensive, so therefore it requires a lot of energy generation. So companies that's involved in the energy space will definitely benefit and therefore command higher valuation. So last but not least, I think it's important as a trader, you want to look at the market, you need technical tools to help you, to aid you, to make sure that, in whatever market circumstances is, you're able to find opportunities in the market. Now, there's two major ways to trade the market. One is what we call trend trading, and another one is called mean reversion. So trend trading is highly applicable when the market is trending. That's what we are seeing now. Both US and European markets are at all-time high. The trend is upwards. So therefore, there's trend in place. So if you employ or deploy trend trading strategies, you probably can get some opportunities. So just to show you where we are, you look at it, so we have the S&P 500, which is highlighted in the red line. We have the DAX, which is highlighted in the black line, and we have the Euro Stock 50, which is highlighted in the slight green line. So you can see that, DAX is slightly up, or not slightly, I think it's generally outperforming the Euro Stock market. So Euro Stock comprises of the rest of other European countries like France, Spain, and the rest. So you can see that, German economy really is performing far on top of the rest of other European region. But if that's the case, even S&P 500 is still the champion when it comes to market performance. So year to date, I think S&P 500 is at all-time high levels. And obviously, last night with the decision from Federal Reserve to cut interest rate, it actually propelled the index to higher levels as well. So really, I think DAX is clearly outperforming the Euro Stoxx 50 at this point and juncture. Now, if you just put a sidetrack for a while, if you just look at where US market is, a lot of people will be asking, hey, is US market, Dow Jones, S&P 500, Russells are looking at high levels and higher. So are we going to see a peak soon? Now, what I have here in this chart is to look at the margin depth, which is provided by FINRA against the S&P 500 performance. So you can clearly see, and this FINRA is in terms of change, year-on-year change. So whenever there's a positive change in terms of margin depth, it's just telling you that generally the retailers are piling in using margin as a way to leverage their position in the stock market. Now, obviously, retailers want to be in the stock market to make money. So obviously, they believe that as long as they're optimistic that the market can continue to ride higher, they'll pile in more margin depth. So as long as positive change are recorded on a yearly basis in terms of margin depth, excluding the absolute levels, we can clearly or safely say that market can still be well supported. Now, the thing to take note of is that once the year-on-year change starts to turn negative, or even absolute levels are starting to come down, which means that investors are starting to feel that valuations are too stretched, there's not much room of growth, or even growth has been internalized by the prices, and therefore I think it's time for them to be out of the market. And when margin debt starts to decline, and even year-on-year change starts to become negative, normally we will see quite a sharp correction in the market. So I would say, if you are really watching the US market, one of the key indicators that you should be paying closely or watching closely is to look at the FINRA margin depth year-on-year change as well. Now, coming to addition and deletion. So as I mentioned earlier, late last month, we have addition and deletion from the Euro Stoxx 50 and also the DAX market. So the prominent figure from DAX is definitely we saw Porsche coming out, and going in will be the GE group, and even we have Siemens Energy going into the Euro Stoxx 50. So you can see that some of these energy companies are getting more, more position and ranking in terms of the index composition. So really, you can see the economy of Europe is slowly transitioning from traditional economy and moving into a new economy, which means that energy is not new; it's also traditional, but riding the theme that as the AI progresses, as the need for data centers rises, there's definitely be more need for energy companies to step up, and they require more funding. So as a result, you can see companies like energy companies will demand better valuation as compared to traditional economies like automobile. Nowadays you have so many competition. Porsche will always compete with Tesla, or even in China we have so many other EV models. So really it's a very saturated market. But having said that, is given time probably they might revamp, and probably there's a bit of optimism in that regard. But for now, really can see that the economy is slowly transitioning from traditional economy and moving into the new economy, which is very energy driven. Now, as you always know that every time when the stock is about to be included in the index, normally the pre rally or pre inclusion, you can see that stock prices of the particular stocks that's included will tend to rally. But once they are included, normally there'll be a sell off. But having said that, given that Siemens Energy is a well company that is also involved in data centers across Europe, especially in Germany, that this would be quite a good team. Just to put a disclaimer, this is not a stock recommendation, but it's merely just telling you that the theme that the index is probably concentrating is putting more energy companies into the picture to reflect what the existing economy wants, existing economy breath. Now, obviously, Porsche got kicked out, and you can see that prior to that, there's been a lot of selling pressure. Institution has been selling, and even coupled with that, earnings was actually not too good. The latest earnings was showing that they are actually in negative. So really, the stock prices took a tumble. So these are usually the effect of stocks as being deleted from the index. So Porsche is having quite a challenge. Like I think one of the key things is that competitions are very fierce across the region. Like I mentioned, you have US makers, you have China makers. They are also all equally very good. So Porsche, as a result, they faced by intense competition. They are losing out that particular competitive race. So let's see. Hopefully, with drive and innovation, they can change or coming up with new models. Then they can reinvigorate, the company's image once again. Now, talking about policies, Trump policies and politics in US and Europe. So if you can see, Germany, the largest economy in Europe, the major trading partner used to be, China, but recently you can see that US is actually gaining higher proportion. So we can see past couple of, I think early last year, we can see that there's actually more goods going into, or rather more goods going into US rather than going into China from Germany. So really, I think it's very interesting to watch whether how Germany is going to play at whose card. Is it going to be China or US? Again, depending on trade deals that's being offered. Now, Trump being Trump, he always likes to negotiate. So it's good to see whether is there anything significant that is going to be presented on the table. Now, if you just look at Trump tariff in totality, especially applying on the EU market, so you can see that a lot of shares are being presented in the pharmaceutical and auto section. So obviously, with tariff being implemented, so this demands generally the general demand will slowly decline. So let's see. I think hopefully in months to come or weeks to come, there probably be a better deal reached. That eventually you can start to see some of these key sectors, especially the pharmaceutical and the automobile sectors, will start to pick up in terms of momentum. Now, talking about a new economy in Europe. So, if you just look at it, the power demand for AI centers are just going to quadruple in the next 10 years. So it's crazy. The demand for energy intensity is going to be huge. So right now, there's even talks that we may renewable energy may not be sufficient. We need to go back into the traditional energy derivation, whether it's nuclear, whether it's coal fuel. So really, I think the proliferation of AI and robotics, these are all creating the demand for energy. Now, percentage of breakdown for global data by region, you can see that Europe is at least one quarter. The US is the largest, so Europe is definitely a big region when it comes to data center, and Germany is the biggest player in this area. So you just look at data center connection requests, you can see that Germany is one of the highest among the European region. And Germany continue to demand that capacity and continue to add capacity year on year. So I think Europe definitely is going to be having the need for more energy going forward. Now, in terms of power demand growth, you can see that projections is done by Goldman Sachs. Every year looking at easily 1% to 2% incremental growth, and you go higher and higher as each year passes by. And this is just to tell you and to put concrete the idea that with the AI as a major theme in the next decade, data centers is a must. And you need energy to drive them. Without energy, these data centers can't run. So let's talk about seasonality in terms of DAX. Now, these are monthly seasonality in terms of prices, and so for the past 5 years. So you notice that for months like September and October is pretty mixed, but September usually is considered quite a weak month for DAX. Now, as we enter into the last 2 months of the year, normally it's a strong month strong last 2 months for the DAX market. Now, if you look at even January is actually quite mixed. February is actually quite a good month, and April is also quite a good month. April and May. So really, seasonality gives you the picture that as we enter into year end, the optimism can still be maintained. Now, seasonality has its doubts. Whether there's always a question whether the pattern will always reoccur, or whether the pattern will follow itself again. So that's always a doubt that we always have if we look at seasonality patterns. Now, this is Euro Stoxx 50. You can see that it's slightly different from DAX. Euro stocks are generally quite underperforming. And if you look at it, it's quite an inverse scenario. So in the next 2 months, towards the year end of 2025, you can clearly see that November, December usually is not a good period when it comes to the performance of Euro Stoxx 50, because in those 2 months, those two last remaining months of the year, they tend to perform negatively. So this seasonality pattern does tells you. Now again, we have to take it with a pinch of salt. There will be bound be a year that this year it could be different, but it helps you as a guide. So if you are thinking to try to long the Euro Stoxx 50 during November, December, you got to be very careful, because based on past couple of years of data, it does show that during November, December, these are the periods where index tends to perform quite badly. Now, so going back to that, the DAX is slightly different story. DAX, November, December is actually a strong period. So if you want to, instead of you want to long the market thinking that it's going to be quite bullish, you should look at DAX, which has a better opportunity or higher chances in terms of making the trend right. Now, coming to the second part of the webinar. Now, I think it's important that we look at trends in the market, especially when markets are trending. Now, if markets are not trending, then you can't use trend trading strategy. So it's important that we can distinguish that. If the market is moving sideways, if you try to do trend trading, it's going to be very difficult. So the first key thing that for us to identify is to make sure that can we identify whether the market is trending or moving sideways. So there's many ways to do it. One is to look at it visually. Another one, you can actually pair moving averages and to see where the prices are in relation to the moving averages. So if the prices are above the moving averages, very likely the market is heading upwards. If the prices are below the moving averages, likely the prices is going to come down. It's a downtrend market. So if the prices are sticking with the moving averages, the market is sideways. So visually, another way, which is comparing the highs with the highs of the subsequent candles and the lows with the subsequent low candles, and to see where the position is relatively. So if you see higher highs in the chart and you see higher lows, generally the market is on an uptrend. Lower highs and lower lows, generally the market is on a downtrend. So that's how we look at it visually. Now, another great way or one great tool when it comes to looking at trends is what we call using Heiken-Ashi candles. Now it's getting very popular because it's first thing is simple to use, and second thing, I think if you are using programming or you do automated trading, you can program the formulas on Heiken-Ashi candles into your formulas. So therefore, it's actually easy. You can do automation using Heiken-Ashi candles. Other than that, I think if you compare to Japan's candlesticks, there's actually many other benefits. We're going to share with you on later slides. So besides, if you just look at Heiken-Ashi, it may not be sufficient. So you got to pair with other trend tools that you can use. One of it is definitely moving averages. Another one you can use now DMI crossover, which I'm going to explain a little bit more further later, is a trend tool. But a lot of people will always use DMI for the ADX line, which is part of DMI or one of the component of DMI. So this ADX is important because once you identify the trend is going up. You need to make sure whether is this uptrend sustained. If it's not sustainable, then very likely the market is going to come down. So one thing to take note of is that a lot of people use DMI mainly for the ADX value. So we need that because if the market is trending up, we want to be making sure that the market is trending higher with strength. There's no point if you enter the uptrend, the market is very exhausted, and ADX will tell you there's a lower value or ADX starts to come down, which I'm going to share with you how we identify that. So it's important. So DMI is mainly used to make sure that there's still strength left in the market or in the trend, the particular trend at that point in time. Now, last but not least, in every trading plan that you have, regardless what strategy you do or you deploy, you must have a way to manage your risk. Because as a trader, we intend to stay long in the business or long in the business of trading. Managing risk is the top priority. It's not about making money. We want to survive the variability of the market, and in order to do that, we make sure that our loss are kept minimal. If we suddenly suffer a huge loss and we couldn't come back to the market, and that's it, that will be our future of trading. So really, I think the important aspect of setting a trading plan is the key important criteria to make sure you have a way or a setup or method to manage your risk. In other words, ways to put your stop loss. So in my example, which I shared, most commonly is to use ATR, which stands for average true range, and we use a fraction or a value or multiple based on the ATR value, which I'm going to share with you on later slides as well. Okay, so ways to determine trend in the chart I mentioned earlier. So visually is looking at that, comparing the highs and the lows. Higher highs, higher lows, generally is an uptrend market. Lower highs, lower lows, generally is a downtrend market. Now, if you just look at Euro Stoxx 50, you can see that the highs are getting higher towards the right hand of the chart. The lows are also getting lower, but obviously the highs are struggling right now. As of this was taken as of I think this afternoon. So the highs are struggling. So if today there's no further breakout, very likely it's going to be consolidation, or if it's a red candle bar down today, that's going to be a temporary retraction for this uptrend market. So it's very careful when you start to see small candles forming usually at the top section, especially in the uptrend market. Normally it's a sign of consolidation in the market or waiting for the next direction. And it's crucial. No, if you are trying to think that market has been going up, I try to long, it can be dangerous. But on the longer term picture, you can see that higher highs and higher lows, generally the Euro Stoxx 50 is still on an uptrend market. Now this is DAX. So you can see past couple of months, DAX has actually been hovering around a tight range between the 20,000 level to the 24,000 level. 24,000 is almost like a resistance, psychological resistance. Obviously, the moment you break that, then market will definitely rally higher. But if you compare the high and lows, you can see highs and highs are quite equal, lows are lows and quite equal. So it's a tight range they are playing. But nevertheless, you can still find trends when you go down to smaller time frame. It could be 4 hours or even an hour chart. You can see better trend formation over there. But on daily basis, you can see that actually the market has been consolidating for the past 4 months or so. Now, if you incorporate moving averages, again, you can incorporate moving averages to show you clearly how the market is trending. So here what we have is that you can see prices are trading above both the moving average. So why we put both, one is usually the shorter term and another one is usually the longer term. So as long as the candles are above the shorter term and the longer term, it's just telling you that the market is poised, or the market is on an uptrend basis. So and keep in mind, the moving averages are also acting like a dynamic support line for the candles. As long as the candle doesn't break, for example, the short-term candle, which is the red color line, then that tells you that this uptrend is well supported. But if it does break, you have to make sure that this red line is going to be a test of support. If it breaks that, then the next critical support will be the blue line, which is the longer term moving average. So moving averages are not only to tell you where the position of the candle is, to tell you the market where the market trend is, but it's also to help you, to aid you by putting an additional dynamic resistance and support level for your candles accordingly. So introduction of Heiken Ashi. Heiken Ashi is basically in Japan is an average bar, and like I mentioned, it's based on a fixed set of modified formula. You can get that formula online, but nowadays, I think most charting platform will have Heiken Ashi as part of their candlestick package. So why we use Heiken Ashi instead of Japanese candles? Now, what I have here, you look at these two charts, chart A and chart B. So you can clearly see chart A is, which I think is probably you all will seen this very often, is your Japanese candlesticks. Now chart B, you can see a series of green, red, but you don't see gaps. So the major difference is that, if you look at chart A, the Japanese candlesticks, even though in an uptrend market, the moment you start to see a one long red candle, you will start to panic. So you'll be out of the market very fast. But in Heiken Ashi, it will not be a red candle. It probably could be a small green candle. That's how the derivation of it. So in a sense that, Heiken actually helps you to identify trends and helps you to stay longer in a position when the market is trending. Now the only disadvantage, I won't say disadvantage, but the only difference is that if you are using gap as a strategy, looking at price gaps, you can't use Heiken Ashi. So you have to convert back into Japanese candlesticks. So why Heiken Ashi is popular for trend trading? Because generally it's based on colors. Green color means that the market is going up. Red color means the market is coming down. And generally, if you see almost like a dodgy candle, like a cross, that means the market is sideways. That's as easy as that. Now, so just to distinguish the difference between Japanese candlestick and Heiken Ashi is so popular because there's only 3 distinct patterns that you need to know. Now, Japanese candlesticks is traditional. It's been there for ages. If you read the Steve Nissen's handbook, he talks about 100 over patterns. Now, 100 over patterns to master on candlestick is not going to be easy. So therefore, that illustrates the point why Heiken Ashi is much betterly suited to identify trends in a particular point in the market. So candlesticks, like I mentioned earlier, it illustrates price gap, but Heiken Ashi doesn't. So if you want to use gap analysis, gap trading, you got to convert back into Japanese candlesticks. Now these are the 3 distinct patterns of Heiken Ashi candles. So one, you should, if you want to see strong trends in the market, you should only see, example in an uptrend market, you only should see green candle bar with upper wick, and vice versa, downtrend market, red candle bar, lower wick. Now when you start to see candles with upper and lower wick, it's telling you that this uptrend or downtrend momentum is losing strength. So normally if you're holding into a position, the moment you start to see upper and lower wick appearing, you got to be a bit more doubtful. But you still can hold to a position. It will get more panic when you start to see the bodies are shrinking, almost, this is what I call a third pattern, almost like a doji. That is where normally it tells you that the trend is almost facing exhaustion. It's now consolidating and it's probably waiting for the next trend in the market. So when you start to see dodgy style of candles, that usually tells you the market is pretty much exhausted in terms of trend, and it's going to go sideways for quite some time. So the market can stay sideways for a very long time. A lot of misconception is that, the moment it stays sideways, I'm going to wait for the next trend. It will take time. Now this is the dynamics of it. Like I mentioned earlier, strong red candles with only lower wicks is considered a strong downtrend pattern. The moment you start to see upper and lower wick, is telling you that this downtrend is getting weak. And obviously, if you start to see appearance of green candle after that, that's where you need to be careful, because this area here is telling you market is side range. So if you try to do trend here, it's not going to be easy. And if you try to time the market or try to time the next trend movement, it's also not going to be easy. So the best way forward is to make sure that you wait until there's a confirmation of a strong green candle here to tell you that's probably going to be a trend reversal happening in the next couple of sessions. Now, Heiken actually is not sufficient, so therefore you need to incorporate moving averages. So there's two types of moving averages, two commonly used. One is simple moving average, and another one is exponential. So a lot of people prefer exponential because it actually gravitates with the price much faster compared to simple moving average, because the formula of exponential takes more weight into a recent prices. So because of that, many people prefer to use EMA type of moving average. Now, keep in mind, moving average is still a laggard indicator. It's based on historical prices. But having said that, it's quite useful in terms of determining where the trend is by looking at where prices in relation to where the moving averages line is. And I also showed you earlier, these averages lines are also acting like a dynamic support and resistance for the candles. Now, the third main function is if you pair a short-term and a longer-term moving averages, you can get what we call crossovers. So crossovers, the moment a shorter-term moving averages crosses above the longer-term moving averages, generally the market is considered bullish. Then shorter-term crosses below, generally the market is bearish. Okay, so this is an example here. So what we have here is that you can see that the shorter term crosses above the longer term moving average. The red one is shorter term. I think this is 9-period EMA. The blue one is a 20-period EMA. So the moment when the shorter term crosses above the longer term, generally this is a bullish crossover. Now, to get the confirmation, you look at the Heiken Ashi candles. So the Heiken Ashi candles are starting to turn green and the body of the candles are white. So it's telling you that this upward momentum is strong. And keep in mind, you look at where the small appearance of red candle is, and it doesn't break this blue color moving averages line, which is your 20-period EMA. So it's an indication that despite we see a short retracement in terms of this upward strength, the market still can head higher because it's well supported by the 20 EMA. Now, unlike this here, with penetration of a strong appearance of a strong red body candle, that's a different story. That's telling you that this uptrend market is losing strength. So again, you can see that the usefulness of the moving averages giving you as a dynamic resistance. So you can see there's multiple attempts to try to break the 20-period EMA, but they fail until the appearance of green candle here. So this is telling you that not only moving averages giving you crossover signals, it's also acting, like a dynamic resistance and support level for your candles. Now, the third indicator is what we call the DMI. Now, DMI stands for Directional Movement Index. That is also used mainly for trend direction. Now, in DMI indicator, the components that consist of three. One, we have the positive directional index, we have the negative directional index, and we have the ADX. So the main component that a lot of people is relying on DMI is actually the ADX component, which measures the strength of the trend. So I mentioned earlier, once you identify the trend of the market, you need to know whether is there still strength in the uptrend or in the downtrend market. And to do that, we need to look at the ADX value. So how do we interpret DMI? So DMI indicator, we have three lines. The positive DI, which is usually means positive momentum is strong. Negative DI usually coincide with negative momentum being strong. So there's this, when these lines crosses each other, technically there's a signal. So it's very similar to a moving average crossovers. So like a bullish crossover, which means that the positive DI crosses above. Negative crossover or bearish crossover happens when the negative line crosses above the positive line. So what is more important is this ADX line. Now, ADX line runs on the value of 0 to 100, almost like your RSI. The common rule of thumb is that any ADX value that's above 25 telling you there's an appearance of trend. And any ADX value that's below 20 is telling you that the market is weak or is a range-bound market. Now, here what we have here is that, first I want to show you is that this bottom panel is the DMI indicator. You have the red and the green line, which is your negative DI and your positive DI. So negative DI crosses above the green line, which means that this market is heading for a short-term downtrend. So true enough, you can see appearance of red Heiken Ashi bars, and it's below both the moving averages. So technically, this is a short-term downtrend market. Now, the moving average, if you look at it, where the moving average crossover happens and the DMI crossover happens, they're actually very similar. So in other words, these two indicators overlap in certain signals generation. So one, you may opt for just using moving average crossovers, or you can just use DMI crossovers. You want to do both, can, but sometimes it get kind of confusing when you put too much lines on your chart. So same goes, even this is for on DAX. You can see that the moment when the DMI crossovers happens, it's actually quite overlap with your moving average crossovers. Now what is important is that this DMI is for the function of this black line here. So you can see this ADX, the black line is, this is a blue line which stands for value of 25. So the moment the blue line crosses above 25, it's telling you there's an appearance of trend. So what we have here, this example here, is that you can see this bearish crossover happens. Despite you see small green candle bars, it doesn't break the 20 period EMA. Is still pretty much a downtrend market. But the key thing is that ADX is rising, so it's telling you that it's unlikely to break. This downtrend is still strong because the ADX is still rising. Now ADX starts to pick around here, which means there's the appearance of green, and you can see that this green candle starts to break the 20 period EMA. So that's where it's telling you that this downtrend market is losing strength. So really, I think ADX points to you, at which area of the trend that is gaining momentum and which area that is losing momentum in terms of the strength of the trend. Now, last bit, in every trading plan, you must have a way to manage your risk. So average true range is basically an indicator to measure the true range of the particular period. Basically taking the current high minus the previous close, current low minus the previous close, and you can put it onto a moving average, and normally the default period is 14 period, based on if you don't change the default settings. So when you have high ATR value, that means the market is very volatile. So as a trader, it depends. If you are a trader that likes volatility in the market, so obviously you are waiting for high ATR movements. But if you are a trader who prefers low ATR value, that means you prefer when markets are more settled down or more range. So therefore, you're observing for lower ATR value. So just to show you a picture, so bottom panel here is actually the ATR measurement. So this is basically on the DAX market. So April, when the start of liberalization effect by Trump, we noticed that the market actually plunged. And during that time, the ATR value went to as high as almost 1,000 points on a single day. So that tells you when you have this kind of sharp movement, normally it could be a market panic, normally it could be a market news or market driven, or whether it's a global market, geopolitics. Usually those are what drives volatility in the market. Now, obviously these periods, if you get the trend right, you make good money, but if you don't get it right, you don't put stop loss well tight, you can get stopped out very easily. So this is where I think it's important and it's crucial to take note. So right now ATR for the DAX market is, you can see, is slightly inching lower. So it's telling you that actually the market is consolidating, still consolidating at this point in time. So how do we create a trade setup? So first thing is to identify there's a bearish crossover in your moving averages and the candles are red, and ADX starts to go above 25. So once you have that set up, I think pretty much sure that the trend is quite in place. So you put an ATR at that point, which is 15 points. So in other words, how do we set your target profit and stop loss? So you can short at 56.16. This is on Euro stocks. Your ATR value is at 15. So we work on a risk to reward ratio of 1 to 2, which is a general ideal situation. I know in reality, sometimes you don't go 1 to 2. Sometimes you go lesser than that. But do what's best. Always be in a position to make more than what you risk. And that eventually on the long run, it will be a profitable business. You don't do 1 to 1 or anything less than what you don't make less than what you risk, because then generally that will not be a profitable business. So by then, 15 points is your stop loss, 30 points is your target profit. From there, you set your stop loss and target profit accordingly. So this is on DAX. You can see this is quite a clean setup. You can see this is a strong red Heiken Ashi bars. Below both the moving averages, there's a bearish crossover. What's interesting to take note is that you can see ADX slowly inching higher. So ATR is for 60 points. So the same principle applies. If ATR value is 60 points, 120 points for reward, 60 points for stop loss. Now the key thing is about stop loss. So you put your stop loss based on the volatility of the market. So if the market is highly volatile, that means you have to prepare to assume a bigger movement or bigger loss in your portfolio. Now you don't want to set too tight a stop loss, because eventually when markets are volatile, you can get stopped out easily. So that's the equation. But again, that's a trade-off for it. if you're willing to not put a tight stop loss, you're willing to put a bigger stop loss, that is a risk that you got to bear. So this is something that you really got to take note. But the key thing is that you must have a way to manage your risk in case the market go against you. Okay, so now in terms of technical bits, you can see FDEX are still pretty much well consolidated in a range between 24,000 and the 17,000 range. It's a quite big range. So therefore, I think on a daily basis, daily chart period, you can see that market is still quite consolidating at this point in time. So we have to wait for the next couple of sessions to see how the session is going to behave and where the market is going to go. And if you look at the the DMI indicator, ADX value is still below 25. That means market is still quite uh, range. So there's no trend in place. So you got to wait until ADX is above 25. Then probably there's a range that you can see. ATR is quite low because generally the market is consolidating at this point in time. Now, Euro stocks is something different. Euro stocks, you can see, based on visually, it's still going higher. The charts, the candles are well supported above the moving averages. The only key problem is that ADX has actually went below 25. So it's telling you that this period here is a consolidation period for the Euro stocks market. So if it does break this red and green line, it's generally tell you the market is going to hit lower. So Euro stocks market, I would say short term is going to be quite a range market. So we got to be very careful. You're hoping that this uptrend can continue. It's going to be something to watch out for. Okay, so having said about DAX and Euro stocks, I think Eurex has recently also launched micro contracts which make it easily accessible for retailers to participate in the European market. Now, European market generally is going to be a quite exciting market because you just look at where the transition is happening. You're talking about energy companies coming to the mix that's focused on being more AI related, data driven, which is going to be a future theme it's ongoing theme. So it's going to get a lot of interest, and hopefully that will be more trading opportunities. So if you want to find out more about these micro Eurex products, just do speak to any of the Phillip Noah members. They can be more than happy to engage with you with the latest information on the product itself. So I'm just going to end here with a quote. So if you know Alexander Elder is a very famous trader. He always mentioned this. I think the goal of a successful trader is not to make the best. Is to make the best trades, but it's never about the money. The money is always secondary. So as long as you keep your processes right, everything is in order. Money, you should see your trades become profitable. So when I say processes, that means you make sure that you have a stop loss in place. Then if you are wrong consecutively, you got to stop. So the key thing is all about risk management. So like even Jack Swagger has mentioned, he has authored so many, or he has interviewed so many legend traders. He mentioned this: amateurs thinks about how to make how much money they can make, but professional traders always think of how much money they could lose. So it's always the risk and lose equation that's quite paramount, and that usually always equates to trading psychology. So I'm just going to end here and probably hand it over to Sri for any questions from the audience. Sri?
Yeah, thank you so much, David, for your valuable insights. Members of the audience, this is your chance to ask questions. If you have any questions on what David has shared today, if you have any questions pertaining to the European markets, please send your questions here. We do have Eurex promotion ongoing right now. So since we have only 12 minutes left, I'll send the details on the promotion in our follow-up email. Meanwhile, let's take some questions. We'll just head on to your question box and let's see if you have any questions. David, maybe to kick things off, are you able to share the top three takeaways? Maybe a little bit about why European markets are something that we should be looking at right now, and three reasons why we should
Okay,
take a
yeah.
look, or are there any recent changes that we should be aware of?
Okay. So I'll put it into 3 points. The first point is now if you I think a lot of people are too concentrated on the US market because
Sorry,
the
David.
hype of
If you want to flash your slide, you can. You can go ahead and
ah
flash it in case you want
okay.
to highlight a point.
Actually I don't have any slides, but okay, maybe I just flash my slides so that it's something that everybody can see as well. So going back to the question three, I'll put it into this. I'll summarize it into these 3 points. The first point is always this. I think a lot of traders are too focused on looking at um, the US market, for example. The US market is very saturated in the sense that the concentration is too high. So if you just look at S&P 500, majority of the earners or majority of the price gains are only limited to the Magnificent Seven. So it's a very concentration risk. So if any of these seven companies don't do well, you can see a huge correction in terms of the index performance. But if you look at Euro Stocks 50, it's a very well balanced. Despite you're seeing some components being added and being deleted, but it's quite a balanced index. So really, Europe provides more stability in terms of really on the index performance as compared to US market. US market in general, especially right now, is still very a concentrated market. And obviously, you look at valuations; they're all way overstretched. Now, second point is this. I think if you look at it, as I mentioned earlier, the transition is going from the traditional to a new economy, which is focusing on talking about energy, talking about tech, which is going to be the future thing. So it's not only US is riding the team, now Europeans are also riding the team, and it's just beginning. So when you just started, there's always more opportunity to be established. So I think, and third point is I feel that the nature volatility of Eurex products, despite certain periods are very volatile, but if you compare to other markets, generally they are still quite okay. There's still trends in place. So the volatility of the market is still quite acceptable. So hopefully that 3 points can summarize your question.
All right. Thank you so much, David. Members of the audience, let me see. Take a look at the question box right now. I don't see any questions here. If you have any other questions, you can send them our way. David, you mentioned that there were some changes in terms of the weighting of the index. Um, um, can you explain a little bit about why there are changes here, and what is it heavily leaning on right now?
I don't have the actual composition of the index itself,
Sure,
so I can't
sure.
really give
Yeah,
precise percentage.
yeah.
But Porsche just listed probably about like 3 4 years ago, and because the underperformance over the years and recent quarters is actually quite sharp, so therefore based on the index rebalancing, it actually got selected to be removed. And like I mentioned, a lot of team that's coming into the European market is all looking at energy space because they know that data centers is high in demand. European market is now playing the catch-up game. So no, they're investing into energy companies. So therefore, they actually check up the valuations, and therefore, they are prime suspect to be included into the index. So I would say that's how the rebalancing is looking at the focus. But the actual percentage, I may not know.
Okay. So looking at, I mean, we have a few European indices listed on the Eurex. If I were new to the European markets, what would you recommend that I have a look at first? If would it be the DAX or Eurostox 50, and maybe you can share
Okay.
some reasons why.
Okay, now if you prefer a more volatile market, DAX is highly volatile. The movement per day could be about what 80, 100, sometimes to even thousands. But if you prefer something that is less volatile, the Eurostock 50 is much preferred. So it depends on the nature of the trader. If you just started in the market, he wants to get a dabble of how the European market works and how the European index perform, then Eurostox 50 could be a better choice. But if you need more volatility, especially when markets are in heavy movement, then DAX is a better candidate.
All right, thank you so much, David. I don't see any other questions on hand at the moment. Is there anything else you'd like to share, David, before we close the session for today?
I'll say this. I think going forward, trading the market is not going to be easy because the Trump impact is still there. Trump being Trump, he's highly volatile, uncertain. Anything he says can move markets. So, if you're a trader, you really got to embrace that kind of volatility. So it goes back, if you goes back to trading 101, you can't run away from making sure that you have all the plan in place. When I say plan in place, a plan to enter, a plan to exit, and more important, to establish a plan to exit. So regardless any market that you trade, you must have a plan to get off with and to get in with, and you must have a plan to get out as well. And keep your heads up high, especially when markets are volatile. Sometimes, the rewards may not be rewarding, but when always make sure you don't get a hit from the market that that enable you to make a comeback in the market. That would be quite sad eventually.
David, I hope we have time for one more. We have a
Sure,
question
sure. Go
from
ahead.
Chunhua. Chunhua is asking for the European trading hours for the European markets. Is it suitable for someone based in Malaysia or Singapore?
I think to me it's suitable because if you look at the active hours, normally probably about 4 p.m., 5 p.m. So you're transitioning away. If you are trading in Malaysia or just Singapore, you're just transitioning your aftermarket hours. So it's just nice. It's just coinciding. It's just almost the closing of the Asian markets. So because during the 4 p.m. and 5 p.m. you can see a bit more volatility. Now, obviously, the higher volatility comes in during the US market hours. So if you don't like volatility, you probably could just trade during the European market opens, and when US market opens, probably you want to stay off, and that's it. Now, if you like excitement, you want to trade round the clock. If you're trading both the Asian market and also the European market right until the US market opens to the late or early morning, that's going to be quite taxing. So I would say this is actually very depends on the individual, but Eurex is actually quite a perfect market to be in, especially given that we're staying in Asian market time zone. So just before our market closes, the European market opens, and therefore that we can see a bit of volatility. So we can actually trade during the opening. Hopefully, certain actions happens. Then once everything settled down, you can, if you want to wait for the US market, you can do that. If not, probably you just be just nice just close during the opening of the European market.
All right, ladies and gentlemen, thank you for being a wonderful audience. That was David Ng, proprietary trader for Iceberg X, Noran Bahat. We regularly have him for our live webinars, so if you like what David has shared today, do keep joining us for our live webinars, and we'll definitely bring him on board one of these days to cover another interesting topic once again. Okay, the learning doesn't have to end here. If you have more questions, you can send them in the survey form at the end of the webinar. Until then, have a great end to your trading week and catch you on our next live webinar. Good night and take care.
Okay, thank you, Sri. Good night, everyone.
Thank you, David. Good night.